Let me introduce myself. Hi, this is Rajesh Jain. I'm basically a qualified advocate. I'm a financial graduate from IIM Kozhikode and a company secretary. So I started my career as a practicing advocate. I practiced for 2 years in High Court of Telangana and AP. Then I completed my CS and joined and worked in various corporates such as Surana Group, CK Birla Group. I did my executive program in finance from IIM Kozhikode and then shifted completely to finance. And since then I have been in completely working into the financial domain. I worked as a CFO in Horman Group. And since then I have been working as a financial planner. I'm a SEBI registered equity research analyst. I'm an AMFI registered mutual fund advisor. And I'm IID approved insurance planner and advisor. So I feel that's enough for me to share my credentials. So today we would be talking on mutual funds. So we would be working on what is a mutual fund, how to choose a right mutual fund, because each one of us know mutual funds sahi hai. Am I right? Each one of us know that mutual funds is something where we need to explore investing our hard-earned money into it. But we always wonder how to invest our money into these mutual funds. What is the right mutual fund? Should I invest into equity fund? Should I invest into debt fund? Yeah, it's both confusing. Where to invest? How to invest? Am I right? So today I would be making things very simple for you. I would try to simplify the terms as simple as possible. But if at all you are not still able to understand it clearly, you can ask me to repeat. So let's start. So what all we would be covering today is what is a mutual fund. We would be trying to see what are the various types of mutual funds available. How can you invest into a mutual fund? Which type of mutual fund scheme should you be investing based on your own need? How to choose a right equity fund and how to choose a right debt fund for you. So basically, what is a mutual fund? See, mutual fund is basically a pool of money collected from many investors. See, if I have to invest into stock market, what I need to do? I need to open a demat account, put my money into it, and then I need to start do the transaction on my own. I need to monitor the performance of my portfolio on my own. Am I right? And then if I have to buy so many company stocks, will I be able to do with my limited money? No. So what happened is, to ease out the problem of small investors like you and me, this concept of mutual fund started, where like hundreds, thousands and lakhs of small investors like you and me can come together, pool our funds at one place, make it into form of a kitty which is called a fund, and give the responsibility of managing this fund to a professional who is called a fund manager. So what does this fund manager does? This fund manager will in turn invest our money into various securities, that is financial instruments like stocks, that is shares of any listed company, bonds, which is like giving money on loan to companies, money market instruments. Money market instruments are like instruments which are issued by government, state government, central government, or RBI issues bonds. They borrow money from the banks, from public. So the money market instruments, and there are other assets like gold and all. So mutual fund doesn't mean they only invest into stock market. Mutual fund invests in variety of financial assets. So what happens once they invest this money into it? Ultimately they generate some returns. So these returns, after deducting certain expenses, which is called fund management charges, the returns are given back to us in the form of our finally net asset value, that is what is my value as on date. So this is what the concept of mutual fund is. Now mutual funds started somewhere in 1964. It started with UTI. UTI was the first mutual fund. Then what happened till 87? UTI was a monopoly. Then government allowed. In fact, at that time it was RBI. Currently it is SEBI who is regulating, but at that point of time it was governed by RBI. So RBI allowed public sector banks to start attracting people's money, because at that time people never believed the private sectors. So it was all nationalized, it was all centralized. Government used to have its own banks, public sector banks. Then from 1993 onwards, that is where the real revolution started into mutual funds. A lot of private funds came. Franklin Templeton Mutual Fund was the first mutual fund, first private sector mutual fund to come up in India. And then from 96 onwards, SEBI started regulating this mutual fund industry and the growth started. And today, mutual fund industry is one of the fastest growing financial sector industry, in addition to insurance. So let's understand what are the various jargons. Let us see few jargons about mutual funds. The first and foremost thing which people commonly hear about mutual funds is SIP, isn't it? Very common, you hear about SIP. So SIP is a systematic investment plan. I wonder, many people ask me, Rajesh ki SIP करना चाहिए या म्यूचुअल फंड में इन्वेस्ट करना चाहिए? How many of you have got this doubt or have got this doubt कि म्यूचुअल फंड में इन्वेस्ट करना चाहिए या SIP इन्वेस्ट करना चाहिए? So then I explain them कि बॉस म्यूचुअल फंड में इन्वेस्ट करना चाहिए बट थ्रू SIP. So they get confused कि ये क्या है? I asked him two things कि whether I should invest into mutual fund or SIP, and you are saying you invest into mutual fund through SIP. So SIP is a mode of investment. So if I select a fund, I have got two choice. I can invest my entire money. Say I have got 1 lakh money, 1 lakh rupees. I can invest the entire 1 lakh into a fund at one instance, at a single go. That is called lump sum. So I am investing my money as a lump sum, single payment. But instead of that, what I say is, every month I am getting 1 lakh salary. Out of that, let me do 20,000 investment into this mutual fund. So I start an investment plan which is systematic in nature. Systematic in the sense, every month 20,000 would get deducted from my bank account without any intervention of mine. I need not plan कि फोर्थ को देना, फिफ्थ को देना, 10th को देना, या whether I should invest or not. It happens on its own systematically, and that is what it is called systematic investment plan. It is a reverse of your EMI. Like when you take loan, what happens? Every month the bank will deduct the EMI from your bank account. This is exact reverse of the EMI, because EMI is something which I think most of you would have experienced how the EMI works. The same way, it's a reverse of EMI, where every month your money is debited from your bank account on a prefixed date, but instead of paying for your loan, this is for your future. This is for your future investment. So that's the distinction between SIP and lump sum. So SIP and lump sum are mode in which you can invest into mutual funds. Then there are two kind of funds. One is open-ended fund, second is closed-ended fund. Open-ended fund, as the word itself suggests, that it is open forever. So whenever anyone wants to invest into it, the mutual fund agency will accept additional investment into that fund. That is called open-ended. Another is closed-ended. Closed-ended means something that is closed. That is, I open it, I ask people to invest, I say I would be accepting only 10,000 crores into it. Once I receive 10,000 crores, I close this fund forever, or temporarily I close. Then once I feel okay, from 10,000 I can grow to 15,000 crore, I again open it, again I accept for certain investments, then again I close. That is called close-ended. But most of the funds which we are currently seeing or managing are open-ended funds. Then comes net asset value. This is the NAV. Now, if anyone has an experience of investing into the stock market, you will see, if you are investing into Reliance, the stock price of Reliance will change every day. In fact, not every day. When the stock market is open, every second it changes, isn't it? How many of you have experience in stock market, or have at least opened a demat account and invested at least once in a stock market, or observe how the share prices change? If anyone has an experience with stock market, say I. Type I. Okay, Sandeep has an experience. Sayed has, Priyanka, Harnath. Thanks guys, you made my life easy. So you know how the share price varies, isn't it? So when I'm investing my money into a mutual fund, in turn this fund is investing into 100 other companies, which prices again moving up and down. So how I will know what is my actual investment value, isn't it? Now this actual investment value, what happens is, if I have invested say 1 lakh, so similar to me another 100 people have invested, which makes how much? 1 crore. So this 1 crore is invested into 10 other companies. But today when this 1 crore was invested, in the morning it was 1 crore 10 lakhs, evening it became 1 crore 15 lakhs. All right. By the end of the stock market is over. So this 1 crore 15 lakhs is again divided by number of units that I have issued to the investors. And based on that, the net asset value. So it is the value of per unit. So when you are investing your money into a mutual fund, say any scheme XYZ long-term investment scheme, you have invested it, the mutual fund house will issue you units, 1 unit, 2 unit. It is actually into decimals as well, 2.36 units, 2.45 units. That is how they are issued. Now this unit, based on the net asset value, will calculate what is your total investment value at the time of investment, and as on date what is the present value of your portfolio. So this is what the NAV is calculated. NAV is calculated at the end of the day, every day. After the stock market is closed, the NAV of a fund is again redetermined. So NAV of a fund changes only once in a day. It doesn't move throughout the day based on the stock market price. So it is dynamic, but it changes only once in a day. So the next question comes is, many of the advertisements today are saying invest into a direct fund and save your money from expenses, isn't it? How many of you have heard about these direct funds? You should invest into direct mutual funds. You should invest into direct mutual funds. How many of you have heard about it? Okay, so you have heard about direct mutual funds. Now many of my clients ask me, Rajesh, should I invest into a direct mutual fund or should I invest into a regular mutual fund, and which one is a better? Now, first thing, a direct mutual fund and regular mutual fund both are same. It both the money is invested into a same fund. It is how you invest. Whether I'm investing directly with the mutual fund house or whether I am taking an intermediary, like I'm approaching a financial advisor of mine or an investment planner of mine and asking him to decide which funds I should invest and how to manage my funds, and I'm investing this through him. So when I'm investing directly on my own, it is a direct mutual fund. So say I'm investing my money into say Parag Parekh Flexi Cap Fund. Now Parag Parekh Flexi Cap Fund, if I'm investing directly, it would say Parag Parekh Investment Fund Direct. But if I'm investing through any mutual fund advisor, then it will say Parag Parekh Flexi Cap Fund Regular. Now in direct mutual fund, there is no intermediary. It is you and the mutual fund house directly. And in regular mutual fund, there is someone in between. Now, which one is better? Depends on you. If you have someone who have good idea about mutual funds, you know how to rationalize your portfolio, you know how to monitor the mutual funds performance, then you can invest directly. Then direct mutual fund investment would be a better option for you. But if you are someone who needs guidance, who needs support, who needs a professional advice, ki Rajesh, I want to invest 20,000 per month, which funds would be better? Now I have been investing for the last 1 year, which fund I should keep return in my portfolio and which I should replace with another fund? If you need such kind of guidance, then you should approach any investment advisor or a mutual fund advisor and invest into a regular mutual fund. So I hope these jargons are very clear to you all. So if they are all clear, type clear. And if you have any doubt, type what is your doubt. I will clear that here. Because understanding these terms or the jargons that we use in mutual funds is very important. Good. So the next thing is market capitalization. What is a market capitalization? You hear there are like large cap fund, mid cap fund, small cap fund. What is this cap? This cap means capitalization. Now, what does this capitalization means? Say I'm a listed company. So recently you would have heard that yesterday Nika has become a 1 lakh crore capitalized company. So how this 1 lakh crore comes? From where this capitalization comes? So this capitalization is market value of a share. So whatever is the market quoted price of that company share into total number of shares. So say our company Myswish tomorrow goes public. So we have 1 lakh shares. So we have issued 1 lakh shares and we go public and it becomes at 100 rupees. So what would be the market capitalization of my company? 100 rupees is the market value and I have issued 1 lakh shares of my company. So what would be the market value? Can someone calculate quickly? Yes, we know it is 1 lakh into 100, that is 1 crore. Now this 100, if it becomes 150, if this 100 becomes 150, what would be the market capitalization? Yes, it will become 1.5 crores. Am I right? So this is the called market capitalization. So what happens is there are almost more than 5,000 companies listed in stock market. More than 5,000 companies. Now this 5,000 companies based on their market capitalization is ranked. And based on their rank, the first 100 company, that is 1 to 100, first 100 companies are called large cap companies. Large cap means large capitalization. Then 100 to 250, that is 150 companies, that is the next 150 companies are called mid cap companies. And thereafter all companies which are more than 250, which are 250 and below, that is 251 onwards, they are called small cap companies. So basically large cap, mid cap and small cap. Now when it comes to large cap companies because of their size and they are so big, they are perceived to be stable. They are perceived to be very stable in the market. Like Reliance is there. How many of you feel even after next 10 years, Reliance would continue doing good? It will not go bankrupt. How many of you feel that? How many of you feel that Reliance? Am I right? I'm sure 99% of you or 100% of you would feel Reliance would stay even after next 10 years. But if I say any small cap company which has listed recently, blue chip company means this large cap company only. Large cap was earlier known as blue chip. SEBI later made it into a large cap, mid cap, and small cap for the purpose of clear cut understanding and no ambiguity. Else, before this large cap nomenclature was given, earlier they used to be called as blue chip. Blue chip company means big companies, huge companies. So these large cap companies are basically expected to be stable. Now mid cap companies are companies which have grown in size, which are big enough but not huge. They are something in between, but they have a potential to grow. So these companies, they are stable but not as stable as large cap. So here, what do you think the risk when it comes when I'm investing into mid cap company which is not that large as a large cap company? Will my risk will be more than the large cap or less than the large cap? Or you feel the risk would be same whether I invest into large cap or mid cap? Yes, it would be more. It would be more than large. Now, when I'm investing into small cap company, which is yet smaller, my risk increases. My risk becomes much more. So that's why for people who are risk averse or someone who are new to the market, we basically advise them to invest either into a large cap or a mid cap fund. And people who are aggressive, no market and are willing to take higher risk, they should invest into small cap funds more. So these are the top, sorry, I have written as top 10, but they are top 20 mutual fund houses and the data is as on September 2021. I missed to update the heading. So this is the latest data and the top mutual fund in India is currently SBI. Mira Asset is also one of the mutual fund houses. You can see Mira Asset at the 11th rank. Mira Asset is at the 11th rank. So these are the top 20 mutual fund houses in India. How many number of funds, that is the number of schemes that they have launched, number of funds, and what is the kind of asset they are managing. AUM means asset under management. That is what the amount of money that they are managing as on date. So SBI is managing 5,78,000 crores as on date, which is followed by ICICI, then HDFC, then Aditya Birla. And this is how your top 20 companies are. Now, these top 20 companies are based on the size, doesn't mean that number one company is more efficient and the number 20 company is less efficient. So it all depends on the same. But if you see, the schemes vary. Few companies have lesser schemes, few companies have higher schemes. The number of mutual funds. So this is where the whole complexity comes. That where should I like? There are so many funds being managed by these companies. Where should I invest? This is where the whole complexity comes. And out of these mutual fund houses, which fund house is better? How many of you recall that there was a fiasco with Franklin Templeton? Franklin Templeton suddenly one day shut down its 6 debt funds and said whoever has invested into these debt funds cannot withdraw money. Ultimately, after 1.5 2 years, the investors into that company got some amount back, but there was a fiasco. So you cannot say that big company is good and a smaller company is not so good. So what we basically have to do is analyze which mutual fund house is better managed, and also which fund is better managed. And how we should analyze, I will tell you in some moment. I don't think I need to even explain to you why you should be investing into for mutual funds. But I would just tell one thing, that one reason why you should be investing into mutual funds is we have got so many responsibilities at various stage of lives. At various stages of life, we have got so many responsibilities. And for every responsibility, there is one financial tag. There is a price tag for almost each and every responsibility, isn't it? Whether it is my kids' education, my kids' marriage, whether I want to buy a house, whether I want to buy a dream car, whatever may be, every desire, every wish of mine comes with some other price tag. Now, if I have to meet this, somewhere I need to plan very properly and invest for long term. Mutual funds bring in a lot of flexibility. Mutual fund bring in that you can invest for any tenure, you can invest whenever you are comfortable, in whichever manner you are comfortable, and also you need not worry about managing them much. So basically, people who don't have much time to manage their funds, I suggest them that was secure your family by taking a term insurance, and rest, invest your money into mutual funds. That's the best way to start your investments. And once you grow in future by accumulating good amount of wealth, then you can start planning investments into other areas like real estate is there, gold. Anyway, you need not plan, it becomes inevitable that whenever your wife wishes, you need to invest your money into gold. So gold, you need not plan for that. Yeah. So here comes the funds, the whole pyramid of the funds. So what are the various types of funds? First, let us see the funds in terms of asset class. So what are the various asset classes? The asset classes, already I said in the starting that mutual funds invest into variety of assets. That is equity. Equity means shares of various company. Equity means shares of various companies. So equity, then debt. Debt means I'm giving my money on loan. I'm not investing. I'm not investing into your business. I'm giving you loan. Like if I bought shares of Reliance, it becomes equity. But instead of that, I buy a bond or a commercial paper or a debenture from Reliance. So these are all debt instruments where Reliance says that you give me a crore rupees and I will repay back you in 5 years or 10 years and I will give you an interest which is fixed. So that is debt instrument. Then there is hybrid. As the word itself says, hybrid means mix. So it's a mix of both equity and debt. So the hybrid funds. Then there are gold funds, which are investing primarily either into gold or companies which are into gold mining and all. So there are different kind of gold funds. Then there is something called fund of funds. Fund of fund means I invest into an X fund. This X fund go and invest into three different funds. That is A, B, C fund. So A can be equity, B can be a debt fund, and C can be a gold fund. So this is how the fund is invested. So there are fund of funds. Which is safer in it? I would address that also, Sharat. So just wait. To which fund would better suit you is something I would be taking up once I explain all the funds. So then funds can also be divided in terms of the way they are managed. So management is an active fund and passive fund. Active means where a fund manager will actively decide how much money where I have to invest. And passive funds means fund manager will not use any of his discretion. Like there are index funds. Nowadays, many of you ask me, Rajesh, should I invest my money into index fund? So index funds are something which are not actively managed, they are passively managed. What happens is I park my money into an index fund. The fund manager will take my money and he will just copy index like nifty index contains 50 companies, so he will invest in these 50 companies based on their weightage into index. That's it. He will do every time I receive funds, I will invest in the same proportion. When there is any change in the nifty, new company comes into this top this 50 number, I replace my existing company with that. So that is how it is managed. So not much of my discretion. I just try to copy the benchmark, which is an index. Nifty 50 can be Nifty mid cap 150 can, whatever is the index I'm benchmarking, I just try to copy it. That is how they are managed. So basically, if you're investing direct, I suggest the new investors to always invest into index funds. Put your money into index so that you are safe. You need not worry about analyzing whether the fund manager is performing well, whether he's managing this fund very well or not. But if you are investing through an advisor, or once you get hands on with how to evaluate a fund on your own, then you can start putting your money into active funds and start with large cap, mid cap, and then go to a small cap funds. So the type of funds, again, if I divide like equity funds, so already we have discussed what large cap, mid cap, and small cap is. So there is something called multi cap or flexi cap. The new nomenclature given, one more added, is flexi cap. So you will get a multi cap fund and a flexi cap fund. Now don't get confused whether that a multi cap and a flexi cap is same. No, they are not same. SEBI made its alteration where in a multi cap fund they made it a mandatory that at least 25% of my money should be invested in all three. That is 25% minimum in large cap, 25% minimum in mid cap, 25% in minimum in small cap. And a fund manager cannot go beyond what is in mandate. So if I'm a fund manager of a multi cap fund, I need to mandatorily park my money 25% into large cap, 25% into mid cap, and 25% into small cap. But if that fund is a flexi cap, then I can invest into any of this based on my discretion. Like I can invest 80% into large cap and 20% into small cap, or I can invest 50% into mid cap, 20% into large cap, and 30% into small cap, whichever way I feel. That is a flexi cap fund. So multi cap fund where there is a restriction on how much percentage to be invested. Flexi cap, there is no restriction on the fund manager, he uses his discretion. Then there is something called sectoral funds. These sectoral funds I suggest investors to avoid. As the fund description itself says, the funds are invested into certain sector. So if I say IT, information technology, so I'm investing only in information technology companies. If I say financial services, I'm investing only in banks, insurances, companies related to the financial sector. So these sectoral funds are highly risky in nature. And why they are risky in nature is because it depends, the entire money is invested primarily into a sector and it depends on how that sector performs. If the sector collapses, so suddenly banks, like post COVID, there was a huge concern that banks may collapse. People would not repay their debts, and the banks would collapse. And had the banks collapsed, what would have happened? All the money invested into financial services sectoral funds would have gone down the drain. So sectoral funds are highly risky, and unless you have an understanding of a sector, like I'm working in an IT company and I know how IT company's future is going to be, and I'm very confident that for the next 10 years or 20 years, because now post COVID there is again a digital revolution, These IT companies are going to do very well, and the future lies in IT. So I can invest into a technology companies, technology funds. But if I have no understanding, I better restrict myself to large, mid and small cap, or try to invest more into flexi cap fund. कि यार मेरे को headache नहीं चाहिए. Let the fund manager decide कि उसको कितना किस में डालना है. That how much he needs to invest into large cap, how much into mid cap or small cap. Let him take a call. I would just invest my money into a flexi cap fund. Similarly, there is something called debt funds. In debt funds, there are categories like liquid funds, ultra short term funds, short and mid term funds, and long term. So this is basically demarcated based on the time of investment and the kind of instrument they invest. Like liquid funds primarily invest into government treasury bonds, which will get liquidated or get repaid in next. They would be getting repaid in next 30 to 60 days. So it is for a very ultra short term period. So these funds are basically for very ultra short term period. Now there is something called short and mid term, long term. So long term funds invest into debt instruments where the repayment period is 5 years, 7 years, 10 years. So basically they are invested into corporate bonds. And then aggressive hybrid funds. So hybrid fund is both a combination of equity and debt. So in this again there is an aggressive and conservative more. Hybrid aggressive would be where equity percentage more and debt percentage is less. Hybrid conservative is where are a balance advantage fund. Nowadays they are calling it as a balance advantage fund or balance fund. So balance fund conservative. So conservative where the debt component is more and equity component is less. So modes of investment we already discussed, like what is an SIP or lump sum. Okay, so you guys want me to repeat what is an SIP? Okay, yeah, okay. So SIP is basically, see, this will give an example. Now SIP is basically what I can do. I can invest my 9,000 rupees at one go, or I can invest this money 9,000, 1,000 every month for the next 9 months. So say I'm investing 1,000 for the next one month. So every month 1,000 is invested, and based on the net asset value, the unit price on that month, I will be getting the units. So say first month the unit price is 50 rupees. I'm investing 1,000 rupees. I'm getting 20 units against lump sum. So I'm investing this entire 9,000 rupees. I'm getting 180 rupees, 180 units. So in SIP, what happens is this 50 became 47, 47 became 45, 45 became 44, 46, 48. That is, market is falling. And then again, the market is growing. So whether the market is falling or market is growing, you invest every month and you try to use the opportunity. Whenever the market is falling, you will get more units. Whenever the market is growing, you will be getting lesser units. Overall, it will get averaged out. So your investments will get averaged out. And okay, that is one advantage. Second thing, what happens is, as I told you already, that SIP is exactly reverse of your EMIs. So when I am taking a loan, what happens? I take a loan lump sum 10 lakhs, and this 10 lakhs I'm repaying every month, say 1 lakh rupees each. So that is my EMI. So instead of that, reverse. My target is to accumulate 10 lakhs. Now to accumulate this 10 lakhs, what I am doing is I'm investing 1 lakh every month. So when I'm investing this 1 lakh every month, this is called SIP, that is systematic investment plan, where systematically every month I'm investing my money into a pre-selected mutual fund scheme on a pre-selected date. Syed says, can I choose monthly lump sum? So monthly lump sum is SIP, Syed, but yes, I didn't got your question, Syed. That can I choose? Okay, Ashish says, is there a limit to investment? Can it vary each month? See, Ashish, first thing is when you are investing into an SIP, you already fix the amount that you want to invest. Say I'm taking an SIP, I'm planning to invest 10,000 rupees every month. So I will start an SIP of 10,000, maybe 2,000 in 5 funds. So 2,000 into 5 funds. So every month automatically this 2,000 will get invested into this 5 funds. On say 5th of every month I want to invest, on 5th of month 10,000 will get deducted. Now, if at all any month I don't want to invest, what I can do, I can plan it in advance and pause my SIP. If I want to increase my investment, I can add on. If I want to decrease my investment, I can stop any of one of my SIP. Let's say 10,000, from 10,000 I want to reduce it to 8,000. What I can do, I can stop one SIP of 2,000 and I can reduce my investment. So there is a flexibility. So there is no commitment saying that once you have started an SIP, you should continue to invest forever. There is no compulsion. There is a flexibility in SIP that you start now, and tomorrow if you are not comfortable, you can stop it. Tomorrow you want to invest more, you can increase it. If you want to invest less, you can decrease it. Yeah. Dheeraj has asked me, is it good idea to go with small cap? Dheeraj, if you are a aggressive investor, if you don't mind taking risk, and if you are investing for a long time, then you should go for a small cap investment, but a portion of your funds. So I suggest basically not to invest more than 20 to 30% of your entire portfolio into small cap. You should restrict your maximum exposure to small cap to 25 to 30% of your portfolio. Say I'm investing 10,000 rupees. I should not invest more than 2 to 3,000 into a small cap fund. Rest should be either in a flexi cap or a large cap or a mid cap funds. Okay. Now Sudarshan is asking, is it suggestible to go with SIP on our understanding for better results, or to go with agency that they can consider for good results? Sudarshan, it depends on you. See, if you say I will take ET money and I will go with fund selected by ET money, I would not suggest you, because what basically happens is, though this ET money and all, they say it's a direct funds, there are no this thing, but they get an indirect consideration to recommend certain funds. So they will basically recommend funds which they want to sell it to you, and not one which are suited to you. First thing. Second thing is, my approach, at least I cannot say about others, but what my approach is, I basically divide the portfolio. So say if you want to invest 10,000, I would divide your portfolio, like depending on the kind of investor you are, I would divide your portfolio into large cap, mid cap, small cap, and flexi cap. This you cannot do it directly through ET money, because they will only recommend you the funds. They will not give you the demarcation. If you can do it on your own, then you go with this thing. But if you need someone, if you need some support of a professional to monitor your portfolio and to suggest how way to invest, then you should go through some investment advisor or a mutual fund advisor. But if you can do it on your own, then you should go into a direct fund. So let's move to the next topic, how to choose the right equity fund. Now for choosing the right equity fund, what we basically need to look at is, what is the objective of the fund? What is the duration you intend to hold? Like for how long? Objective of investment, like for what purpose you are investing, whether you are investing for your kids' future, whether you are investing for your retirement, for what purpose you are investing, determine, and for how long this investment is going to be. So duration, that how long you are going to hold this investment. Third, category of your fund based on your risk profile. So we already discussed that large cap is less risky, small cap is very risky, flexi cap is moderate. So based on your risk profile, you need to choose the category of the fund that you want to invest. Then what is the fund's portfolio? That is the composition of the fund. What is the size of the fund? Now how to look at this, I will just teach you in a moment. Whether the fund is performing consistently or not, and what is the track record of the fund manager, how the fund manager is performing, what is the expense ratio of this fund, and finally, what are the various risk measures, how the risk measures of this fund are performing. I've just taken you all to the value research site. Yeah. So here in the value research site, first thing that you can observe is there is some rating that is given. So this fund is rated as 5-star. If you see here, there's a direct plan and regular plan. So if you change this, see, if you see here, your regular plan, my 1 lakh investment grown to 2.23 lakhs. Same direct plan, my 1 lakh investment grown to 2.29 lakhs. So there is a difference of 6,000. Now the 6,000 is why the difference is, the 6,000 is the commission that has been paid to your mutual fund advisor. So this is what the difference is. Now here, if you see, come down, first what you can do is, you can read that for whom this fund is suited to. For whom this fund is suited to. Here it is available the equity, that is what is the category of the fund. So this fund is called FlexiCap fund. Then investment details. So what is the minimum investment that you can do? 1000 rupees you can invest minimum as a lump sum. Minimum SIP is 1000. And if you are starting an SIP, you need to give a minimum commitment of 6 months, and after that you can stop at any point of time. So the commitment is only for the first 6 months. Minimum withdrawal is 1000 rupees and minimum balance is 1 rupee. That's it. Lock-in period, there is no lock-in. You can withdraw your money at any point of time and exit load. So when I'm redeeming it, so if I'm redeeming it in say first 365 days, then 2% is my exit load. That is within 1 year. If I'm redeeming, redemption means withdrawing my money. If I'm withdrawing my money in first 1 year, then 2% is my exit load. That is 2%. Like if I'm withdrawing 1 lakh in first 1 year, 2%, that is how much? 20 rupees would be deducted by the mutual fund house as an exit load. And if I'm withdrawing after 1 year, in next 2 years, 1 to 2 years, it is 1%, and after 2 years, no exit load. So this is the exit load. But I can withdraw at any point of time. Here you can see what is the taxability. So how it is taxed. So mutual funds normally are subject to long-term capital gain tax. And long-term capital gain means any mutual fund, equity mutual fund which you are holding for more than 1 year would be eligible for a long-term capital gain tax. That is taxed at the rate of 10% over and above 1 lakh gain. Now this is, you can read this. This is available here. I'm not going to touch this much currently. Then there are basic details of this fund. That what is this fund house, who is managing this, when this fund was launched, what is the return since launch. So since launch, there is 2013 onwards till date, year on year, the fund has given 22% return. Then what is the benchmark index? It is Nifty 500. Because it's a flexi-cap fund, it can invest into any kind of funds. It is benchmarked with Nifty 500. That is top 500 companies. How they have performed, it is benchmarked with that. If you see riskometer, the risk is very high. Type of fund, which is an open-ended. What is the assets that this fund is managing? 17,220 crores. Expense, that is out of this fund, what is the expense? So every year 0.85% is the expense which this fund is withdrawing from the fund. Now here the major area where you need to look. So in value research, what it does is it gives grading. It gives risk grade and return grade. So in flexi cap type of funds, there are various funds. Out of all the funds, these funds take low risk, and in spite of taking low risk when compared to its peers, it is giving you high return. So what you would prefer? Will you prefer taking low risk and high return, or high risk and high return? What you would be preferring? Obviously it is low risk and high return. And this is one area where I basically recommend you that see whether the kind of risk the fund is taking is low or high. So prefer low or an average risk. Riskometer is high. Ashish, riskometer will tell you that what is the risk involved in that category of fund. So when you are investing into equities, that to flexi cap, the risk per se is very high. Now here when it comes to risk grade is apple to apple, that is within the flexi cap fund. So there are say 50 flexi cap funds. Out of the 50 flexi cap funds, this fund takes lower risk when compared to other flexi cap funds and gives you a higher return when compared to other flexi cap funds. I hope I'm clear. Yeah. So this is first factor which you can look at, the risk grade. And second is turnover. Now turnover means out of say 10 funds, out of 10 companies where this fund has invested, only 17.63, that is 1.76 companies, that is only 2 companies have replaced. So wherever this turnover is low, so I basically prefer funds where this turnover is low. If this turnover is high, so say for example, if I'm investing, see, my objective is a long-term investment. Now when I'm investing for a long term, what I will do? Will I buy and sell companies every day? or I will stay, buy a company, stay invested for some time, and if there is any issue, only then I will sell that company and buy another company, isn't it? So this turnover indicates how often the fund manager is buying and selling, buying and selling. So if this turnover is say 80% or 90%, that means in a year, almost everything that the fund manager has bought, he has sold. So if the fund manager has sold everything that he has bought within a year only, then how it can be a long-term investment? And when my objective is a long-term investment and the fund manager is holding it for a short time, is it a match? No, it is not. It is not a match. So I will show you in comparison this. I will show you with other fund also how this will go in comparison. Now here, if you see trailing return, now trailing return is something that you need to see is how consistent this fund has been. So see, the fund has performed like for in 1 year it has given 58%, 3 years it has given 31%, in 5 years 23%, in 7 years 19.98%. So now here it is a ranking. So whether it is consistently in the top, and basically for equity funds and where you are investing for a long term, you need to see this 3, 5, and 7 years horizon, not the short term. In short term, a fund may perform really well, fund may perform really low. But in a long term, हमें क्या देखना है कि ये लंबी रोज का घोड़ा है या नहीं, और लंबी रेस में कैसे काम करता है, हाउ इट रियली परफॉर्म्स इन ए लॉन्ग टर्म. And then there is certain peer comparison of other funds, which we will do in just a minute. Then best and worst performance. So here what we need to see is there any where the downside is very high, whether in a year or a quarter, whether there is a huge downfall. So if you see any point of time my fund has not gone below 30%, say my 100 rupees has not fallen below 70 rupees, then here comes the risk measure. So risk measure, I would just explain you in brief, but if you guys forget and tomorrow if you want to again look at it, there's a simple way. If I click here, automatically it will tell me what this is and what is a better. So mean is average of monthly returns generated in the last 3 years. So what is my mean average? Last 3 years, what is my average? Standard deviation. What is the total volatility of the fund? That is how the fund is going up and down. And the higher the standard deviation, the greater the volatility is. So I would prefer a fund which has low standard deviation, which is less volatile, isn't it? If standard deviation is high, the standard deviation means this is a standard. From standard to what extent this fund deviates. So it can deviate on this side, that is, it can deviate both on positive performance or it can deviate even on the negative performance. So I would prefer a fund which doesn't move much and it is more stable. So I would prefer something which is stable. So if I need to look for a fund which is stable in its performance, I need to go for a fund which has less standard deviation. That is, so here it is like the category of all the funds. This is the category of the funds, and this is this fund risk measure. So if I add up all the funds in this category, it is 20.98 standard deviation. If I'm looking at the index, that is the benchmark index, it is 21.79, and this Parak Parak Flexi Cap, it is 17.72. That is far lesser than the industry average and also the benchmark. And that is if you see the rank within the category is 2. So if you see in all the risk parameters, this fund is ranked either on 1, 2 or 3 out of 42, and that is why it is my favorite fund. That is why this fund is my all-time favorite. Then there is something called Sharpe ratio. Now Sharpe ratio explains that once I adjust my risk, that the kind of risks that the fund manager is taking, if I adjust the risk, what is the kind of return, higher return that the fund manager is generated. So what happens is when the fund manager takes low risk and gives a high return, then this Sharpe ratio would be very high. And this is what is the case in this fund. So if you see the Sharpe ratio is 1.41 against the industry average of 0.84 and 88. And that is why it is ranked as number 1. Same is Sortino. Now Sortino is what is the returns that are generated against the downside risk. Like I'm not taking much risk, I'm adjusting it again what it can go below, and still it is generating a higher return. So the higher the measure, what is the higher Sortino, it would again be better. So again, if you see, this fund is performing better than the industry average. Beta, what is a beta? Beta indicates how sensitive this fund is. That if the stock market, say stock market falls by 1,000 points, it has fallen by 1,000 point. One beta means even this fund will fall by 1,000 point. If my beta is 0.8, that is my fund will fall by 800 points instead of 1,000. If my beta is 1.2, that is my fund will fall by 1,200 points against 1,000 points. So this is what beta is. So basically, you tell me whether the beta should be less than 1 or more than 1. What would you prefer? A higher beta or a lower beta? A lower beta. So when it comes to Sharpe and Sortino ratio, it is higher because it is giving me higher returns. It is showing how much higher return my fund is giving in comparison to my risk taken. Whereas beta is giving me that if there is a volatility in the fund, in the stock market, how much my fund will oscillate. So the lower the beta, it is better. And if you see against the industry average of 0.93, this fund beta is 0.79, 0.73. And similarly, alpha. Now, alpha is what is the return that the fund has generated over and above the benchmark risk taken. So if you see where the benchmark is 1.42, whereas all the funds on an average has given a return of 1.42% more than the benchmark, this fund has given 11.84, and that's the reason even on alpha it is on number 1. So this is the risk measure. So on risk measure, basically I see, so normally people tend to get fooled by this, that what is the performance this fund is giving. But always remember one disclaimer, that past performance doesn't guarantee the future performance of a fund. But what will guarantee a future performance of fund is how the fund manager is managing the risk, because equity investment is all about managing your risk well. Then if you see here, it would be where the portfolio, as I told you, this is a flexi cap fund. So see, it has invested 60% into Giant. Giant means your top 50 companies, then large, mid only 14.54, and small only 3.56. So if you see, currently this fund is invested primarily into large cap funds and less into small and mid cap funds. It is not exposed heavily into mid and small cap funds. Now this can vary. So tomorrow, once the fund manager feels that mid and small cap are attractively priced, he can increase his allocation into mid and small cap. So this is what the flexibility is there in the hands of fund manager. You can also see sector wise allocation, that which sector it has been invested, like the category, all other funds in the category where they are invested, and how this fund is invested. So this fund is more technology biased. It has invested more into technology companies. And why it is technology biased? Because it has invested, this is one of the fund of its kind which has invested even into foreign companies. If you see Alphabet, how many of you know Alphabet? How many of you know this company called Alphabet? Almost everybody, am I right? Everyone would be knowing this company. Yeah, it's a Google's parent company. Yeah, Alphabet. Now Alphabet, if you see Microsoft, if you see Amazon, these are the companies where this fund has invested, and that's why it is technology biased. And out of various flexi cap funds, this is the only fund which is invested heavily into these companies. This is one of the USP of this fund particularly. Now here you can see the fund manager credentials, that who the fund manager is, since when he is the fund manager, what are the various funds that he is managing. You can even see their performance, and you can even look at interviews if he has given any interviews, or you can read about the fund manager credentials. So what we basically see is how consistent the fund manager is, whether the fund house is changing the fund manager. Like since 2013, this person is managing the fund, that is from inception is continuing to manage the fund. So that shows that the fund is consistent with regard to fund manager, first thing. Second, you can see the performance is more consistent. So the fund manager is performing well. And you can even look at the other funds whether the other funds are also being performed well. So then you can confidently say, okay, this per fund manager, my money is in safe hands. Now I will just tell you for a brief, I will just show you another company, any other flexicap fund. Now Axis Focus 25. This is another popular flexicap fund. And if you see here, yeah, risk grade is average, return grade average, and see the turnover. See the turnover, how much turnover? 139 percentage. So this fund manager is not investing for long term, and he's actually trading. He's investing, he's buying, selling. So he has not only sold all the funds that he have bought, he has resold it multiple times. So that is why this high turnover ratio. So though this fund is performing really well, I would try to avoid this fund, because what is happening is this fund manager is doing lot of efforts churning, because he's not having confidence on his own investments. He's doing a lot of churning to generate these returns. So there will be high volatility. So if I see on the risk measure, if you see the risk measure, see standard deviation where this fund is performing 26 out of 43. You see the risk measures, it is very high. Though the on return grades, if you see 5 years and 7 years, though on the return grade it is fourth ranked, it is generated high returns. But you see on the risk measure, so that's the reason it is generating, it is taking average risk, but return is only above average. And if you, this is the fund composition. If you see, these are all Indian companies only. Who is the fund manager? So since 2016, again the same fund manager is continuing. There is no change in the fund manager. Yeah. So this is the summary of the risk measures: alpha, beta, standard deviation, Sharpe ratio, and Sortino, and what it measures, and which one is better. That is, I would select a fund which is having an higher alpha. I will select a. Now, guys, I'm very sure this risk measure which I'm training you know, not many would tell you about this. First thing. Second, most of the investment advisors themselves, they don't look into this kind of ratios. Basically, most of them look into the performance, because that is very easy to sell. If I tell you, sir, this fund is performing consistently well, it is generating more than 18% return, 20% return consistently, that's enough. That is easy to convince you, no? I need not look into all this stuff. But if you are really serious about your money and want to invest on your own, then please ensure that you train yourself into looking these risk measures and invest only after checking out these risk measures on your own. I never select a fund or shortlist a fund for any of my clients without looking into these ratios and without satisfying myself with these ratios. I just don't go with the numbers. Then comes debt funds. Now, why should one invest into debt fund? Can anyone tell me? Why should you invest into a debt fund? When equity funds are giving more return, obviously equity funds will give you more return than a debt fund. But why should one invest into a debt fund? Yes, we know, rightly said, one is safety. I would not say no risk at all, low risk. Remember, there is no investment without any risk. Even your fixed deposits are risky. Only thing is, the risk is low. There is no concept called no risk. Even your bank can go bankrupt, isn't it? Yes Bank, the latest classic example. Don't forget, guys. So don't say that there is no risk. Yeah, they are almost as safe as a fixed deposit, but gives you a higher return than fixed deposit. So that is why you should be investing into a debt fund. And if you want to invest into equity fund, tell me what is the minimum tenure that you should be holding? What is the minimum tenure that you should be holding if you are investing into an equity fund? Anyone? Take a guess. If you don't know, take a guess. I'm not giving you any answers. I'm not going to penalize you. Yeah, I'm quite impressed. Yes, 5 to 7 years. 5 years is the minimum investment tenure. Recommended 7 years. 6 months, no. 6 months, if you are investing for 6 months, invest into a debt fund. Invest into an equity fund only if your investment tenure is more than 5 years. Else, you avoid it. Why? In short term, stock market is highly volatile. In short term, stock market is highly volatile. But in long term, if you take out any 5 years period, if I take from like say 2001 to 2006, 2002 to 2007, any 5 years period, even 2020 when the stock market crashed, March 2020 to March 2015, if I see, my return will always be positive. So if you are investing for more than 5 years, your return will always be positive so that the risk is less. So when you're investing for less than 5 years, you should consider debt funds. So why you should invest into debt fund is that for the safety. Second, if your duration is less than 10 years, less than 5 years, then you should go for a debt fund. So what I look for into a debt fund is average duration of the fund, what is the fund's portfolio, what is the size of the fund, how have been the returns of that fund, what is the expense ratio. Now I will just show you one equity fund again on the value research. Now I'm just showing you HDFC short-term debt fund. Now how you can choose a debt fund, I will tell you. First, it will tell you what is the duration, whether it is a short duration, ultra short, long term, whatever it is. Then you can see the suitability. So here in suitability itself, the value research will guide you that what should be the period. That is 1 to 3 years. So if your investment is for 1 to 3 years, you should invest into a short-term fund. If it is less than 1 year, you should invest into any guesses? You should invest into an ultra short-term fund. It is less than 1 year, it should invest into an ultra short-term fund. So same again here, you will be getting the investment details similar to your equity funds, the basic details of the fund. Same again, your risk grade and return grade. That is, risk grade is average, return grade is above average. My expense ratio, if you see, it's less than 0.24%. How the returns have been? If you see the returns in the last 3 years have been so consistently between 7 to 8%, so which is more than your fixed deposit. Even in the last 1 year, I see 5.07, which is almost on par with FDs. Most of the FDs are giving 4.5 to 5% return now. So these returns are either on par with fixed deposit or more than fixed deposit. Now here the same risk measures, how the risk measures are, how this fund is performing on the risk measures. But basically what you need to see is average maturity. So average maturity means this entire fund, basically modified duration, this fund is suited for 2.26 years. That is, if your investment is somewhere around 2 years, then this fund is suited to you. So your duration of investment and the fund modified duration somewhere should match. So that indicates whether this is the type of fund where you should invest or not. And second is yield to maturity. So higher the yield to maturity, the better the possibility of a return is. So if you are comparing two debt funds, see which fund is having higher yield to maturity. And second is the credit rating. So this is the credit rating indicates the quality of the debt. So if my fund is investing more into AAA and sovereign, that means it is taking lesser risk. If it is investing less than, so AAA and AA are a good rated debt instruments. If it is anything less than AA, that is A, single A, A1 plus is again a good rating, but if it is single A, then I would avoid. So that means it is taking higher risk. So I would avoid putting my money into risk, because if I want to take risk, then I will go and put into equity. Why should I put my money into a debt fund and end up taking risk? That is what the whole philosophy is. Here you can even see what are the kind of instruments this fund has invested into and who. So if you see, like, it is Government of India security. So this is a Government of India investment. This is Reliance Industries. This is RBI bond, Treasury bills. This is again Government of India. This is HDFC debenture. So if you see, this is the kind of investments this fund has made into, and the fund manager. So now I've told you how to select an equity and debt funds. I hope it is clear now to you that how you should shortlist your equity or debt fund. Now the question comes, which fund suits me? Sharat asked me, even Dheeraj has been continuously sending some messages on my personal window, whether this fund is fine or not. There are even a couple of other also who are sending messages on my direct personal window, whether this is what my portfolio, Rajesh, whether it is good or not. Now, which fund suits me? How should I decide which fund suits me? First, as I told you, time horizon. How long I'm investing. This is very important. How long I'm investing. Based on how long you are investing, you should select your. So as I told you, more than 5 years. Only if you are investing for more than 5 years, only then you should invest into a equity funds. You should go for a debt fund. Second, your risk appetite. So based on your risk appetite, you should take a call whether you invest into a large cap fund, mid cap fund, flexi cap, or a debt fund. Third is expected return. What is the returns that you are expecting? At times, what happens is there is a mismatch between your risk appetite and an expected return. People say, Rajesh, I want to take a low risk, but I want 25% return. But tell me, is it possible by taking low risk or no risk and get 25% return at say 20% return? Is it possible? Tell me. By taking low risk and high return? How many of you feel it is possible to get high returns by taking low risk? And how many of you feel if I want to get high returns, I should be taking high risk? If I want a high return, should I be taking a high risk or a low risk? Type low if you say feel low. If you feel high, type high. Dheera says no risk, no rain. Vinod says that depends on industry knowledge. Sandeep says risk versus reward. Okay. Guys, this is actually something brainwashed up. It is stupidity if I'm taking high risk for high return. वो कोई भी कर लेगा यार, उसके लिए मेरे को इतना मशक्कत करने की जरूरत नहीं है. The real fun is when I can generate higher return by taking lower risk. And that is what I showed you. When I showed that Parak Farak fund, what I showed, that how the fund manager can generate higher return by taking a lower risk. That is what it means. Now, yes, somewhere even the kind of fund also there is a risk involved. So there is certain inherent risk. Now, the inherent risk, whether it is suited to your risk appetite and your time horizon, or this is where you need to look at. And fourth and last but not the least is probability of early withdrawal. You may say, I want to invest for 5 years, but what is the possibility that you may not require it for the next 5 years? If you are someone who have only mutual fund as your investment and there is no other investment at all, and you're always running on a very tight budget, what will happen? Whenever there is some emergency requirement, what will happen? You will come and first dig into your mutual fund, isn't it? So this is where it determines what is the probability of early withdrawal. So if your probability of early withdrawal is there, then you should have a higher composition of debt in your portfolio. If the probability of early withdrawal is not there, then you can have a higher composition of equity fund in your portfolio. I would recommend each one of you to please take a screenshot of this slide. So this slide gives you a gist that what is the kind of fund you should invest for a recommended tenure. So for how much tenure, that if I'm investing for 0 to 30 days, where I should invest, if I'm investing for 1 to 12 months, where I should invest. So it gives you where you should invest for the recommended tenure, what is the risk involved in it, and what is the expected return. So this will guide you where you should be investing it. Now in that category, how to select a proper fund, that also I have trained you. So now tell me guys, do you feel you can start evaluating your own mutual funds, or you can plan how to invest into mutual fund on your own? Are you getting some confidence, or you still feel? Thanks Manjesh. Vinod says up to an extent. Yes Vinod ji, ये तो शुरुआत है. See, this is just a start of your financial literacy. So this at least gives you an insight what and where to look at, and from now on, I'm sure wherever you are investing, like Manjesh said, I opened 6 to 7 without knowledge till now. So now Manjesh knows, ki boss, let me go and see this 6 to 7 what I have invested, whether they are proper or not, and now how I can change it. And now the real Game starts when you start researching on your own. Yes, Ravi Teja, you said you got some knowledge on research. So I have told you how to research. Now it all depends on you that after this session, how often you go on a value research site. You can open an account, it is a free account. Open an account on value research and start evaluating funds on value research. Now, this is yet another synopsis which you should take a screenshot of it. Of that is for a short-term goal where you should invest and long-term goal where you should invest, and based on your risk appetite. So, if you are a risk taker, where you should be investing for your short-term and long-term goal. If you are a risk avoider, where you should be investing for your short-term and long-term goal. So this you just take a screenshot and use it for your future reference. This is a synopsis of what I've think. These are the reference websites: moneycontrol.com, valueresearchonline.com, morningstar.com. These are the websites where you can go and get a lot of information on mutual funds, and also you can research about mutual funds on this site. Value research is my all-time favorite because it gets a lot of. I don't go by value research rating. I don't go by that 4-star and 5-star rating very clearly. I always evaluate how my own research, evaluate the risk parameters on my own, because I have seen many 5-star rated funds with high risk parameters. So I try to avoid that. Now, what are the limitation of mutual funds? There will be no customized portfolio. There is no customized portfolio. You have to go what the fund manager is offering. You cannot say, yes, Sharat, Myswish provides consulting services for mutual funds too, because I am part of Myswish only. Yeah, this is a choice overload. So there are almost 1700 funds currently which are managed by the AMCs. 1700 funds. So out of 1700 funds, choosing 4 to 5 funds is not an easy task. It is slightly cumbersome. So I have given you how you can start shortlisting and how you can come down from this 1700 to maybe 10 to 17 shortlisted funds, and no control over cost. Of course, SEBI has got a mandated, they have put a restriction that what can be the maximum expenditure that a fund can charge, what can be the expense ratio. So SEBI has pruned a lot of things. But frankly speaking, guys, it has become fancy. Post COVID, many have started opening demat accounts, and it has become fancy to go and start trading into stock market without knowing actually what stock market is. So I recommend people, boss, start your investment journey with mutual funds. If you are so fancy about stock markets, learn about stock markets and then invest directly to the stock market. Now, why I say so is, you are so fancy about car. You have went and bought a car. Am I right? Now, if you don't know driving, what will you do? You will hire a driver or you will start driving on your own. What will you do? You will hire a driver, learn driving, and then start driving on your own, isn't it? Same thing. Hire a driver, that means hire a fund manager. Hire a fund manager. Second, learn driving, that is, learn how to invest into the stock markets. And third, start driving on your own. So once you have learned how to invest into the stock markets, then start investing into the stock markets. I had been an SEBI registered equity research analyst. I have surrendered my research, my analyst license, so I don't no more provide research services. But I used to be a SEBI registered equity research analyst, and I have been a fundamental investor. I don't trade, nor I recommend anyone into trading at all. So, guys, quick thing. I want you all to please start typing. What are your key takeaways? What are your quick takeaways? Now, in the meantime, let me check the question. Sudarshan is asking, is it suggestible to go with associated bank MF plans? No, never. Is value research online won't influence like eating money with selected equity? Value research do influence a bit, but it is not biased, frankly. It do influence a bit, but not biased. So that's why I said I don't go with the value research rating, the 4-star, 5-star rating. Why I prefer value research is it gives you entire data that is required for your research. So do your own research. How to select mutual fund advisor? Boss, ask questions. Ask your mutual fund advisor how he selects a mutual fund. And if he's transparent like me, and if you start teaching you like me, then you can go for that advisor. But if he fumbles or say, boss, yours headache, you मैं हूं ना, someone tries to become a Shahrukh Khan with you and says मैं हूं ना, that means he is not the right advisor. Yeah. So I request everyone to please join our WhatsApp community. This is a WhatsApp community called Moving Towards Happiness. Lakshmi, kindly post the link of the community. So this community is basically a community which is on wealth, health, mental health, all. There are 3 coaches on this community. I'm the finance coach monitoring the community. There is a health and fitness coach, Dr. Supreet Kaur, and there is a meditation coach, Shraddha. So 3 of us monitor and also respond to any queries into that community. I request each one of you kindly visit our Facebook page. On Facebook, we are present in the name of Myswish Solutions. So if you go and type Myswish, and Myswish is similar to your wish, so please type Myswish on Facebook page and kindly provide us your rating, your feedback. And if you really appreciate this session today, please go take out 2 minutes time immediately after the session, go and post your reviews. And you can be a part of the WhatsApp community. If you want to connect with me directly, yes, the WhatsApp group is the best way to connect with me directly. I'm also available on LinkedIn and Insta in the name of RJ FinTalks.
I have a question. Actually, we invest in mutual funds in multiple portals or apps, but I wanted to know if income tax portal auto tracks our short-term or long-term capital gains and act upon, or do we have to note down and tax those filings?
See, basically, you are expected to note down and file your filings, but IT department recently has made our life simpler, which with annual investment information, annual information. There is something called AIR, which is available on your income tax portal. You can go and download your AIR. Automatically, all the investments of yours are reported now to income tax authorities through the registrars, whether it is a KFIN or whether it is a CAMS. They have started reporting directly to the income tax authorities based on your PAN number, and you can visit your income tax website and download the AIR.
Okay, thank you.
Yeah. Okay. Parita says, I'm a first time investor for mutual fund. How can I open an account for investing in it? Parita, if you want to invest directly into mutual funds, you can go and open your account with ET Money or any of the free apps. But if you want some support and guidance, what you can do is you can connect with me on the chat window and I will guide you. You can connect with me on my personal window.
Sure. Thank you, Rajesh.
Yeah. Any other doubt, guys? Any feedback that you want to share? If you want to share, please. Okay, I invested in Zerodha and Grow for MFs. I can see all my investments in CDSL, but didn't find any of my Grow app investments. What can I do? Boss, please go and contact their help desk, Grow help desk. They need to figure out, because I'm surprised. Normally, whether you invest through Grow app, whether you invest through Zerodha, or whether you invest through any other person, ultimately it should go and sit onto your CDSL or NSDL demat portfolio. So if the investments are not visible there, then you need to check with your with the Grow whether it is actually reported into, whether they have opened any of your NSDL account, another NSDL account, and there it is being reported to. So then you will find it in your NSDL statement. Any feedback, any questions, you are all welcome. Else, if you feel ki was bahut ho gaya, then we will wrap it up for the day. Nagesh, you can continue investing through Zerodha, not an issue. If you are able to track your funds, if you are able to shortlist funds on your own, you can continue investing into Zerodha. No issues. So from where you invest, through whom you invest, how you invest, that's not important. What is more important is whether you are tracking your investments and whether you are investing after doing some amount of research properly or not. That is what majorly important is. I invested only in index funds. Is it a good idea? Sandeep, to start with, investing only in index funds is fine. But once you get comfortable with mutual fund investing, I would advise you start investing into a few active mutual funds, especially diversify yourselves into flexi cap funds more. Parak Parik FlexiCap fund is, as I told you, is my all-time favorite. You can invest like I generally recommend even 30 to 40% of the total portfolio weightage. You can go into that. Thanks, Sudarshan. Thanks for your great feedback. Okay, guys, then we will end the session.